I made a big mistake in 1982. I won't take you through it because it just probably take too long. But in other words, a big mistake in 82 when I calculated that foreign banks, American banks had lent more to foreign countries than those countries were able to pay back. There was a big debt crisis. I anticipated this debt crisis, Mexico defaulting. Great, okay. But what happened is the economy, and I expected there would be a terrible economic situation. And you know what happened? The Federal Reserve printed a lot of money. You know, you learn the lessons, okay? Those lessons that I learned let me study the 1929 to 32 period, which allowed me to anticipate the 2008 financial crisis. And make a lot of money there when most people lost money. And right now, what's happening now has let Bridgewater and us to make a lot of money while the markets are behaving badly now, because the same thing happened in the past. An order is the system that's operating. How do you operate? So, for example, there is a domestic order. We have a constitution and democracy, and that's a system that operates, and that continues on until there's a war, and then there's another system that comes and replaces it. Our system has lasted for a long time. There's also a world order. In other words, a world system. And that world system of operating comes after a war. Why does a war happen? Because conflicting parties of about equal power have a fight, and the dominant power wins, and then they get to set the rules. And the last time that happened was in 1945 because of the end of World War II. So, you know, when you have the world's reserve currency, the rest of the world wants to save, and they save in that currency. And that leads the country who has the world's reserve currency to borrow. It gives them what's called the exorbitant privilege of being able to borrow and print the world's currency. Boy, that's a good thing to have. And then what they do, of course, is as prosperity continues and asset prices go up, like stocks go up and everything does really well, it encourages more borrowing and spending and betting on prosperity. And that begins to have a rise in levels of indebtedness. So you see debt levels rise. And the third thing it does is it creates greater wealth and values gaps. They become greater naturally. The wealth that's built up is distributed unevenly, and those who make a lot of money then begin to have a larger wealth gap, and that creates also an opportunity gap. If we're lucky enough to have the money, we can educate our children well and so on. That gives them an unfair advantage as in relationship to others. And so this wealth gap increases at the same time as levels of indebtedness increase. And then, of course, what happens is the competition increases. The competition increases because when you win and you have the other Germany or Japan or other countries destroyed after the war and there are no other competitors, then it's a dominant position. But over with time, others learn and begin to build up, like China particularly has increased its per capita income and its competitiveness. And so China is a competitor with the United States, but all through that time, it was like the British were competitors with the Dutch and so on. So we see that pattern happen over and over. As that power gap narrows, then conflicts about how things should go increase. And internally, there is a conflict over wealth and wealth gaps. And then there's a higher level of indebtedness, which makes for a worse set of circumstances. And that combination of circumstances leads to more conflict and more problems. So traditionally, you see that if you have a lot of levels of debt, the classic way that you see this is, what does a government do when it doesn't have enough money? It's not like they go into the coffers. The coffers are empty. They have no gold. They have not that money. So where do they get the money? They have to take the money from somebody else. That's either through taxes, or what they do more, people get angry when they're taking it away and there's a big fight over it. So what they usually do is they print money. And through the Roman times, back in Roman times, they had gold coins. They put less gold in the coins. They put other metals in the coins. And inevitably, they print money when they want to spend more. And that, of course, produces the inflation. It devalues the value of money. And you lose buying power. And when that happens, at the same time, there's a large wealth gap. an opportunity gap. That produces a lot of internal conflict of the sort that we're seeing now. A lot of borrowing of money, a lot of deficits. Back then, gold was money. And money as we know it was like checks in the checkbook that would go get you the gold. You can turn in your paper money for gold, but gold was the real money. And because the United States had borrowed a lot more money than it had, it wrote a lot more checks than it had gold in the bank. And so on August 15th, 1971, when I was clerking on the floor of the New York Stock Exchange, I watched on television as President Nixon defaulted on the obligation to pay gold for the cash. He went on and he said, you won't get the gold. And of course, he didn't say it that way. He said it in a way where it sounded like there were speculators and so on, and he had to do it, but he didn't get the gold. And so on the floor of the New York Stock Exchange, I walked on the floor of the New York Stock Exchange, and I thought the market was going to go down a lot because after all, this is a big crisis and the money as we know it ends. And I couldn't have been more wrong. It went up a lot. And what happened was I never went through a currency devaluation before because in my lifetime there was no currency devaluation. So that's the first time it happened. So I went back and I looked in history and I found the exact same thing happened on March 5th, 1933, except rather than the television and Nixon, it was the radio and Roosevelt, and he made the exact same announcement and it had the exact same effect. And at that time, I learned two big things. I learned that first, that many things that never happened in my lifetime seemed surprising at the time, and that I needed to study things that happened before my lifetime to understand them. So when certain things are happening, like right now, there are certain things that have never happened in our lifetime before, but happened many times in history. So in order to understand them, just as you said in the beginning, I need to understand the patterns, and even more than the patterns, the cause and effect relationships behind the patterns. So that mistake taught me that I needed to understand history. And each of the mistakes has taught me. At the end of World War II, the United States had 80% of the world's money. Gold was money then. It had half the world's economy. It had a dominant military power. And for that reason, because it was the dominant power, New York is where the United Nations is. Washington, D.C. is where the IMF and World Bank, they put it there because it was the American world order. The dollar was the world's reserve currency, and that always happens. Before that, at the end of World War I, there was the Treaty of Versailles, and the winners of the Treaty of Versailles determined how the system was going to work after that. And if you go back in history, repeatedly, there is always a world order. There always happens this way, and it continues. Okay, so how does it work? You end up with that world order, and then you come through a period of peace and prosperity because nobody wants to fight the dominant world power. So that there's peace. And then in that period of time, wars are sort of great equalizers. They reduce wealth differences, wealth gaps, and so on. And then there's a rebuilding process. And that produces prosperity and peace. Also, nobody wants to go back into the war. Everybody remembers how horrible they are. Before that, these cycles typically can take 100 years. Let's say they can take a lifetime.